Hello everybody, welcome back to my channel. This is now from our lecture International Inheritance Tax part 14, and here will now come a few exercise cases where we are still in chapter 2, Introduction to German's Inheritance Tax Law, but now relatively at the end, as you can see. And so let's have a glance at the first case. Father and daughter live both in Cologne, in Germany. Father dies, leaves behind a bank account of 583,213 and a car with a value of 15,000, and that goes to his daughter. Furthermore, there's household property of 60,000, and that's it. The question is, how high will be the inheritance tax in German law? And the answer has to be given naturally, again, with all references and arguments from the law. Well, if we have a look to that case here, the first step which we have to check is probably if there is a taxable transaction or taxable event, or if there have been more than one. You know, all the events between the same persons during the last 10 years will be added up. And we see here, well, it's only one event, so we have to check what that event is. So D inherits because of father's death. That is what, from the perspective of inheritance tax law, that has to be found out just now. And for this, we take a look into the Tax Act. So what we now need is the Inheritance Tax Act. And so let's look to the contents and go here to the Inheritance Tax Act. Seems to work, okay. And now what we need is the list of taxable transactions. Here we have 1.1. Subject to inheritance tax and gift tax are the following events: acquisitions of ground of death, donations between living persons, special purpose transfers, and so on. So our suspicion is naturally we have to do with an acquisition of ground of death. So we have to find that out. That was defined. There was a list in paragraph 3. So let's go on and look for paragraph 3. So paragraph 3.1 of the Inheritance Tax Act in Germany says acquisitions on ground of death are the acquisitions by inheritance, blah, blah, and so on. So that's the confirmation we are right. So we have a taxable transaction on grounds of death. So we can immediately draw that conclusion, that's right, and write it down. So we can immediately taxable event as acquisition on grounds of death, and the two references was 1.1 number 1 of the Inheritance Tax Act plus paragraph 3.1 number 1 Inheritance Tax Act in Germany. Okay, then after the first step, surprisingly, there will be step number 2. The question of the tax liability. Is it unlimited or limited? Again, we will have to take a look into the Tax Act and verify our suspicion that this is probably unlimited tax liability. So let's again have a look into the Tax Act. And indeed, here we are. Now, tax liability was described, as you remember, in paragraph 2 of the German Inheritance Tax Act, and here we can read: the tax liability covers the complete property transferred in cases of 1.1 number 1 to 3, so in our cases, if the deceased at the time of death was an inhabitant of the inland. That seems to be the case in our case, because there somebody lived in Cologne. And now we have still to check if that's correct. And now the second sentence says inhabitant of the inland is some natural person who has a residence or habitual abode in the inland. That seems to confirm that, so we don't have to bother about the other alternatives. So paragraph 2.1, number 1, in combination, or sentence 1 and sentence 2, letter A, give us the proof that this is a case of unlimited tax liability and covers the worldwide property transfer. So, unlimited tax liability because deceased, that's F, was inhabitant of the inland at the time of death. That's paragraph 2.1, sentence 1 plus 2, letter A. That was already everything which we needed here. Now, step 3 was the arisal of the tax. When is our tax due? So, which point of time is relevant for the determination of the tax relevant values? Again, let's take the Tax Act. Okay, according to what we can read here, the tax arises in cases of acquisition on ground of death at the moment of death of the deceased person. Well, there are some exceptions, but none of them is fulfilled, so the basic principle stays valid. So what we have here is just the tax arises at the moment of death. We do not have a given date, so we cannot get more concrete than by just saying that, what we can say here. So we can again write this down and then go on. So let's put it down. Arisal of the tax, the time of death of F, paragraph 9.1, number 1 of the German Inheritance Tax Act. That's it. Now the tax base. Let's have a look to paragraph 10 now. So what we can see here is 10.1, sentence 1. The taxable amount is the enrichment of the acquirer. So we have to calculate that first, as far as it is not tax-free. So tax-free amounts will then have to be deducted. And in cases of paragraph 3, and we had a case of paragraph 3, inheritance, the enrichment is, as far as paragraph 10 does not say something else, that amount which results if the value of the total enrichment determined in accordance with the rules of this law for valuation is lowered by the obligations related to that property which are deductible under paragraphs 3 to 9 and valued according to paragraph 12. So 10.1, sentence 1 and 2 define how we shall calculate the tax base. And so let's do it. So paragraph 10.1, sentence 1 and 2, enrichment of the acquirer as far as not tax-free. So that's here as follows. So we have here first the bank account. And now we should have 587,213 euro. Now we should check how it has to be valued and if and in how far it can be tax-free. This is again, as you can already presume, a matter for our Tax Act. The first thing which we can see here, ladies and gentlemen, is paragraph 11, which says for the valuation of the assets and liabilities, the value is to be taken at the date when the tax arises, so at the moment of death. And the more precise valuation rules can be found in paragraph 12 of the Inheritance Tax Act, which says the valuation is made as far as nothing else is stated in paragraphs 2 to 7 according to the first part of the valuation law, the German Bewertungsgesetz. So we should just try to jump to that valuation law Hope it works. Now, for example, paragraph 12, claims for capital which are not mentioned in paragraph 11 and debts are to be valued with their nominal value. And so let's have a look to paragraph 11, that is shares and securities. So all the other thing. So a bank account is a claim for money against the bank. So the rule here seems to be clear. Valuation with the official nominal value, which, by the way, nobody of us would ever have doubted because it's clear and self-evident. But a good law also has to regulate the seemingly clear things. So let's sum it up and write it down. So to be valued with the nominal value, that was paragraph 12, 1 Inheritance Tax Act plus paragraph 12, 1 of the Valuation Law plus paragraph 11 Inheritance Tax Act. So 583, 213. The next event is that a car has to be handed over. The car to his daughter. Well, and naturally, it has officially a value of 15,000. So we have again to find out how it has to be valued. To be valued with what, ladies and gentlemen? Probably with 15,000, but this is up to now only a suspicion, so we must check it. Our first idea is again paragraph 12, naturally again in combination with paragraph 11, which we probably do not need to mention every time. Paragraph 12 of the Erbschaftssteuergesetz says, let's take the valuation law wherever there is no special deviating rule prescribed. So that seems to be the case here. So let's jump to the Bewertungsgesetz, and there let's, no, that's plainly wrong, badly wrong. Let's take paragraph 9. Sorry for the broken and bad link. Any valuation has to be made with the common value if nothing else is ordered. So, and surprise, nothing else is ordered here for the car. So what's the common value? That's 9.2 of the valuation law. The common value is determined by that price for which the asset in its actual state could be sold under usual circumstances. So that is what IRS would probably, or IFRS would probably call a fair value. Under normal circumstances, the price which you could obtain. So, well, no surprise, naturally, but a good reference. And so we are going to note that and draw that conclusion that the car has to be valued with 15,000. But there was, ladies and gentlemen, something more which you perhaps still remember. There were some tax exemptions, and there was one for movable property. And the tax exemptions, well, the tax exemption here come in the area of paragraph 13. So let's have a look to paragraph 13. And here, indeed, tax-free remain household property up to a certain limit, and other movable property which is not exempted by number 2 in case of acquisition by person of tax class 1, as far as it does not exceed 12,000. So we have then to check what's paragraph 2, real estate property or parts of it, pieces of art collections. No, all that is not a car. So the other movable property might come into play. 12,000 can be tax-free. The only thing we have to check still for that is it tax class 1 if father passes on property to daughter? And tax classes were to be found in paragraph 15. And indeed, children and stepchildren, as you see here, are tax class 1. So let's sum it up and write it down. So our car has to be valued with the common value here, 15,000. See paragraph 12(1), Inheritance Tax Act, Erbschaftssteuergesetz, plus paragraph 9(1) of the valuation law. 12,000 thereof remain, or remains, whatever you like, English grammar is flexible, thereof remain tax-free. See paragraph 13(1). Number 1, or paragraph 13 has no paragraph 13, number 1, letter B, because D as a daughter is tax class 1. See paragraph 15(1), tax class 1, and it was number 2 of the Inheritance Tax Act, which proclaimed her to be tax class 1. So remaining tax liable amount, 3,000 euro. Okay, then let's go on to the household property. That is 60,000, and we can again speculate a bit to be valued with the common value if nothing else is prescribed, demanded. So indeed, that seems to be the same, 60,000. See paragraph 12(1) of the Inheritance Tax Act plus paragraph 9(1) of the valuation law, but tax-free are 41,000 euro. See paragraph 13(1), number 1, letter A, because that was an exemption for persons of tax class A. D is a person of tax class 1. And that is, well, that leads to remaining taxable amount, 19,000 euro. Good. That's it. So let's call it 4B, to summing it all up. We have now 583,230. We have 3,000 from the car. We have 19,000 from the movable household property. That brings us to 605,213. Now, what we still have forgotten is minus the liabilities which are left behind. No liabilities are mentioned then, but in an inheritance case, not cake, there is always one liability which we have to keep in mind, the funeral costs, and they are deductible without proof of further amounts. So if you can't prove further amounts by 10,300, so there we end up with 594,913 euro, and this was to be rounded down to even 100 euro amounts. So 900. You could look that up in paragraph 10(1), and for the sentence, ladies and gentlemen, oh my god, naturally we do not remember the sentence, so we need to look it up. Yeah, as you see here, that nice sentence, the taxable amount is to be rounded down to full 100 euro values, is 10(1) sentence 6. And so we can add this reference as a proof to our step, which we just made, because we rounded down to even 100. So that was 10.1 sentence 6 of the Inheritance Tax Act. Now the next step will have to be taken, let's call it 4C, deduction of the personal allowances. Well, we have tax clause 1, that was C above, and that was 15.1 or 15.1 tax clause 1, number 2, she is a child. And for tax clause 1, what we have is a free allowance of, oh my god, let's look it up in paragraph 16. So what we have here is for children as mentioned in tax clause 1 number 2, and for children of such children if these children are already deceased, so if they are dead and gone, 400,000 euros. So 400,000 euro can be deducted as tax-free amount here. Okay, so we need another, we already have another aspect and can make a note. So for tax clause 1, there was some minus 400,000 euro. So that means we have a new subtotal. And that is, let me have a look and go to the last page again, 594,900. 594,900 minus 400,000. That's, sorry, what remains is 114,900. Now, number 5, let's look for the tax rate for that. So let's calculate the tax as it is. Here we need paragraph 19, 1, and we need it for tax clause 1. And here that means again, let's look. Well, we have here the tax rates for the tax classes, and we must be cautious. We are probably tempted to look at 75,000, but the important word is up to. So we need up to 300,000. We are at 114,900, so we need the tax rate for up to 300,000. That is here 11%. And knowing that, we can go back and begin to calculate. So 11% tax is therefore 11% of 114,900, and that is, according to my calculator, 12,639 euro. Now, there was still a test that was the so-called 19.3 test, which limited the amount, the increase of the tax burden between two thresholds. You remember that phenomenon that if you, for example, surpass the 75,000 euro threshold by €1, the tax rate goes up here by or from 7% to 11% for the whole amount. So that one additional euro would probably trigger an additional tax of several thousand. And to limit that, there was a limit implanted into the tax law, which says, okay, in relation to the last threshold, we establish a formula that the tax burden cannot become too high. And we are going to have a look into that too. So here it is, the difference between the tax which results from paragraph 1 and that tax which would have been payable at the last threshold can or is only levied as far as it can be paid out of 50% of the difference. So the tax at the last threshold would have been how high? 75,000 times 7%. That's all we need to know. So we have now to check the tax at the last threshold to determine the difference to the last threshold and what 50% of that difference is. Oh, so let's calculate. So the tax at the last threshold was 7% on 75,000. That would be, let's take a calculator, 5,250 euro. The difference between taxable amount and last threshold is 114,900 minus 75,000. That is 114,000 minus 75,000 is 39,900, and 50% of that is 19,950. And now that leads to tax at last threshold 5 to 50 plus 50% of the difference. That's 9. That would be 26,950. That is the maximum for the tax. The tax according to the tariff is 12,639. That is lower. So the tax remains the tax under the tariff, 12,639. And that's it. So we have solved our case. Nothing else seems to be relevant here. So congratulations to ourselves. We have solved in extenso the first very, very small inheritance tax and have practiced a bit how that works. If you work on such cases on your own, never forget that you have to always look up things in the tax tariff, in the tax code, and that you have to give proofs from the legal text for everything which you say, because otherwise your solution can't be checked. You otherwise do not prove that you are familiar with the legal rules, and so without any references to the tax acts, your solution would be completely worthless. Okay, now that shall be enough for the first case, and you can already imagine that after the first case, the second case will come. But this is, I think, a good case for another video. Thanks for watching, and goodbye.